Hello and welcome to the Your Financial Pharmacist Real Estate Investing Podcast, a show all about empowering pharmacists to achieve financial freedom through real estate investing. I'm Nate Hedrick, and each week, my co-host David Bright and I explore stories from pharmacists all over the country who are achieving their real estate goals while maintaining a meaningful career in pharmacy. Whether you're a first-time investor or a seasoned pro, we're here to provide education and inspiration about the world of real estate. Please note, this podcast is intended for educational purposes only and should not be considered financial or investment advice.
Before we jump into the episode, let's hear a word from today's sponsor, Lima One Capital. Are you a real estate investor looking for the right lender that can finance all your deals and help you scale? Lima One Capital is the best suite of loan products in the industry. Whether that's fix and flips, fix and holds, building new construction, or buying rental properties, they have incredible financing solutions for it all. A reliable, common sense lender is one of the most important parts of your investment team, and that's exactly what you get at Lima One. Let Lima One Capital show you how they've helped thousands of real estate investors scale and increase their wealth. Check them out at limaone.com/YFP or call 800-259-0595 to speak with a consultant in preparation for your next project. That's limaone.com/YFP.
Hey, David, how's it going?
Hey, good, thanks. How you doing, man?
I am good, thanks. I was at the house again today that I've been working on for a while, and it's a timely discussion because I think we're going to go through a couple of things that will help our listeners and also help me about what to do with it now that we're almost done with the rehab.
Yeah, it's an interesting point to be at the end of that rehab and to have that decision of like, well, now what do I do? Because we all walk into these projects with an idea, right? Like, this is going to be a great rental or this is going to be a great flip project, but like, sometimes circumstances change and market changes and all kinds of things change. So that clear objective and that clear roadmap, like the 12-step checklist that every pharmacist wants, right? Like at the end of the project, when we're rechecking that work, it doesn't always feel like it fits anymore. So it is a good discussion to have, like anytime you're coming to the end of a project, just validating your assumptions and making sure that you're in that groove.
And like you said, a lot has changed just in the last couple of months. I remember vividly, we put the offer on this property on Christmas Eve, actually, kind of just worked out that way. And so back then, again, rates were still low. We weren't dealing with the market that we have today. And again, a lot has changed in 6 months or whatever we've been since then. So it affects our decisions for sure.
Yeah. And I think there's even some things that come out in the rehab project. Like there's a house that we're working on where we pulled up this like 30-year-old carpet and we figured the whole place was just going to be gross and disgusting. And underneath it, it was like that thing that everyone dreams of, right? Like you pull up this gross, disgusting carpet and then there's beautiful hardwood underneath. And we were like, what awesome. In the world? We just hit the lottery, right? Like, yeah, sometimes you find out things about the house, even though you do an inspection, you do walkthroughs, all the things. Sometimes you just learn things about the house that even move the needle a little bit as well.
Yeah, ours kind of went the opposite way. Not terrible or anything, but it was like, oh, we got to do that too. Oh man, we got to, that project as well. All right, yeah, let's throw some money at that problem. Okay, super. My plumber was there like 2 weeks ago, 3 weeks ago, and he's like, yeah, Nate, while I was there, it started raining, and turns out your driveway's backed up too. The drain in your driveway. I'm like, oh man, okay, well, snake that out, please. And like, so again, this one felt like everything kept getting added on every time I turned around.
Yeah, and I hate to like rub salt in that wound, but I think the other thing that changes in the market is like we just saw continued heating because we also put an offer on the house that we're finishing up right now. We put that offer in kind of January and saw that continued climb of the market where we didn't think that this specific neighborhood was all that hot. But then between when we bought it and today, there were 3 like really killer good comps that just made us think that, wow, the value might end up coming out higher than we were expecting. So yeah, sometimes there's market things that change for better, for worse, house things that change for better, for worse. And, you know, in some cases, there's really only one play, right? Like if you buy a lakefront property, it's probably a short-term rental and that's it. You're not really going to put a long-term tenant in it. Or, you know, a property that you bought without needing any rehab that you bought to put a tenant in on day 2 of ownership, you know, maybe that's a clear option because it was very specifically bought for that purpose. But anyone that's taking that distressed house and you're working on it over a series of months, you know, checking your work towards the end, doesn't mean you've done anything wrong even. It just means you're being careful and methodical to maximize that investment.
Yeah, and that's sort of what happened to us, right? So we bought this as tending to be a BRRRR and a rental and a long-term hold. And as we started fixing things up, everything ended up being kind of new, right? We were going to do LVP in certain areas that we ended up just refinishing the hardwoods because it was way better and way easier and just it looked a lot nicer. And so we got toward, the tail end of the project and realized, man, we basically redid everything on this thing. Countertops, paint, top to bottom, flooring, top to bottom. And so all of a sudden we've got this new house sitting there that, yeah, it'd be a great rental, but it is ready to be listed. Like it is brand new. And so we're kind of in that space of, man, what's the best move for us and how do we move forward?
Yeah. And I don't think that you're alone in that situation, right? Because there's some investors that do the major, some investors that do kind of minor rehabs. There's others that hold rentals. But yeah, as we come into the start of summer, which is classically a really good time to list a property for sale, there's seasonal things. There's just all kinds of things in this wild market that are probably worth unpacking because this can be a complex scenario for investors. And so whether, a listener has bought a property and is working on something or just thinking about buying a property and thinking about potential future exit strategies, like this is probably just a really good thing to have in the back of your mind of how to evaluate options and how to know which road to go.
And we've talked about this in the past, right? You and I are big proponents of having multiple exit strategies on a deal, right? If we don't have multiple exit strategies, it really makes us take a second look at the numbers and whether or not we're going to even do it. And so I like those options. I like that you have the option to sell a property for a gain. I like it when you can keep it as a rental. But making that choice sometimes is the hardest part. I know we've done this before where we go through deals and you get 90% of the way through and you still don't know which direction you're going to go. And again, that's exactly where I'm at. So you and I were talking before this, realized this might make a good episode to walk through and really wanted to boil it down to 3 key considerations that you can make or what you can look at when it comes down to how to make that decision.
Yeah. And so, Nate, like you said, every few episodes, we do one of these deep dives where we take a topic that's come up on the podcast where people struggle with this decision of, do I hold on to it? Do I sell it? Mm-hmm. And we unpack that in much greater depth. And so the 3 key characteristics or 3 key questions or 3 key things that we're focusing on today are, what are the near-term and long-term expenses is the first one, near-term and long-term expenses. What's the outlook for value changes in the area is the second one. And the third one is, what do you do with the money when you go to sell that property? What if you get all the proceeds of that sale, what are you going to do? Yeah. So again, that's our deep dive for today, is walking through those 3 things. And so we thought we'd jump into the first one, the expenses, near-term and long-term expenses, to start to look at whether that specific property makes really good sense. Because it's really easy to sit back and look at what you'd think it might rent for, what the mortgage would be, and assume that the difference between the rent and the mortgage is what you make every month, and that's your cash flow. But we broke that down in another deep dive back on episode 50, right? That there's a lot more to it than just rent versus mortgage.
Definitely. And again, some of those expenses might be a little more fixed and predictable. Things like taxes, insurance, even property management fees, like those are really not going to change. It's the things like repairs, capital expenditures, the things that are really going to vary in the short term and the long term that you need to be thinking about. They're a little more nuanced.
Yeah. And so those big expenses, like the capital expenditures that are more of those, a roof every 20 years, a furnace every 15, 20, 25 years, like those kind of major expenses that may be somewhat unpredictable in the moment. Like you may not know precisely the day that the furnace is going to die. But if you have a 30-year-old furnace in a house, like you need to know that that's coming soon, right? And it's a different level of risk than a 6-month-old furnace. Probably not going to die tomorrow compared with a 30-year-old one. So breaking down the capital expenditures, those, small kind of nickel and dime short-term repairs like the dripping faucet, things like that. There are ways to estimate that. We walked through that a little bit on episode 50. Some people use just a fixed estimate based on size of the house. Like someone might say that per square foot, I'm going to recommend this, or per bedroom count, I'll set aside this, or others will use a percent of net rents, which I think is pretty common to look at, say 5, 7.5, 10% of gross rents to the repairs and a similar figure as capital expenditures, with the theory being that setting that aside every month, eventually you'll save up enough to cover that roof. But there's also some nuance there, because if you bought that house that has a 30-year-old furnace and a 20-year-old roof, there's no way that putting aside $50 a month for like 6 months is going to cover those expenses, right? If those things go out. So those are really substantial expenses that could really hurt if you're not planning for those.
And the thing that I think of too is if you know the roof is 5 years away from needing replacement and you're going to sell that house in 3 to 4 years anyway, are you just keeping it so that you can have that big expense down the road? Like, are you just cash flowing now to basically pay yourself back with a new roof later and then go and selling it anyway, sometimes it can be in your best interest to get out of that property sooner because you're avoiding those big expenses. And then even on top of that, you've got those little expenses that can start to add up, right? You don't want those things to nickel and dime you throughout the process of having that particular house. So if you've got a house with, let's say, 2.5 bathrooms and a wet bar in the basement, and like all of a sudden you've got multiple faucets, multiple fixtures, multiple lighting sources, all these things are starting to add up. All those things are things that can break or be updated. And so now all of a sudden, even the little stuff in the repair column starts to really add up based on the specifics of that property.
Yeah, particularly if those things are really old, like if the property hasn't been remodeled in 30 or 40 years, then like all those things could be towards the end of their useful life. And so I know that's one of the things that you and I like buying properties that need some work, is that work can all be done up front, and you don't really feel bad if like the bathroom vanity is just broken and like fallen off the wall, and like, okay, like it needs to be replaced. We'll get a new vanity, we'll get a new faucet, like we'll make it all right. And then you know that there's never going to be zero repairs, because things will still break. Like it's a house, like that happens. But there will always be something, but it gets a little more predictable and a little less risky when right at the beginning of your ownership, you've already gone in and fixed a lot of the things that can go wrong.
Yeah, like pharmacists like the word predictable, right? Especially with investing. We don't need, perfect, but predictable is very nice in terms of being able to plan ahead and knowing which repairs are going to be coming up and when. And even if you can't predict everything, you've got some predictability built in by doing that work up front, like you said. Taking a house that if you're fixing some of the things that break initially, you know exactly how long that's going to last and when you might need to plan for it in the future, which is great.
Yeah. So if we think of it like a pharmacy analogy, like thinking through those near and long-term expenses and all the things that can go wrong in a house, like certainly you can get a home inspection and all that. But I had an ICU pharmacist early on in my career kind of walk me through his approach to doing this like head to toe patient assessment of thinking through like just the major things that he wants to check in on a patient. So you can kind of do a similar thing with a house, right? Like you could look at like what's the chimney and the roof, and then move on to other things about the house. Like maybe we're going to look at siding and windows next, then kitchen and bath and paint, flooring, plumbing, water heater, electrical, heating and cooling, foundation. And you could just work roof to basement literally and think about those big, expensive potential headaches, and then think through what is the condition of each of those, and are they going to need to be replaced sooner or later?
So just taking a second, David, because that's a lot of stuff, right? Like it sounds good, but like roof to basement, there's a lot of pieces and parts in between that. Is that something that, if I'm a new investor or someone that's listening, they're a new investor, like what's a way to start tackling that?
Well, I think about, because we're in the season right now where students have just started their first API rotation, right? Like a lot of them are walking into that first rotation and they're walking into those ICUs with those experienced pharmacists and they're like panicking, right? And so like that's the season where I think that finding your preceptor, like finding a mentor that can walk alongside of you and can show you that, because like your first day as a student walking into that hospital and trying just to tread water, it takes you forever to do some of that work. But the experienced pharmacists in the ICU, they just know it. They just look and they just know what's going on, right? And so connecting with someone like that can be really helpful.
Yeah, definitely recommend that. I think that's a good point, is to connect with somebody that knows what they're doing. If you're not that person yet, it can be a realtor, it can be a home inspector that you trust, it can be a fellow investor that you met. Again, we've had a lot of success talking to other pharmacists. I love going to people like David, yourself. I'll talk to some of their past guests sometimes. I just had a great phone conversation this past week with Kirby Atwell, who we had back on the show a couple of months back. Just things like that are so nice to be able to go to somebody else that knows what they are doing beyond what I'm aware of, and then I can really bounce those ideas off somebody else. It's one of my favorite parts of what we do.
Yeah, and I think that when you're in the trenches and you're walking houses like that, I know for me, working with an experienced realtor that had been through a lot of those, like a lot of investment properties and owned investment properties and had done some of that rehab, like that was really, really helpful. So I think that there's something really crucial about working with a realtor that understands investing and understands construction and home repairs and some of these expenses as well.
Yeah, and that's a good reminder, I guess, a good quick plug for the YFP concierge service. If you are looking for a good investor-friendly real estate agent, definitely encourage you to check out yfprealestate.com. You can connect with me and learn more about our concierge service, where we can get you connected with a investor-friendly real estate agent at no cost. So if you're looking for somebody good in your market or even out of state, that's where I see it kind of being the most helpful, is when you're trying to invest somewhere out of state, need a really good contact on the ground. We can help you get set up with that. We've helped dozens of pharmacists at this point with great real estate contacts. So please check out that service, yfprealestate.com. Just a good reminder based on getting a good real estate agent.
Yeah, absolutely. And having that really good set of eyes to walk through that property and understand some of those expenses just can be super critical. One of the things that we found with the house that we got into, because we also, just like you, bought it with rehab to rent in mind. And we thought this is going to be a great house because it needed some work. There were some things that didn't need attention right away. So it was going to be a faster turn to get it ready. But as we got into it, there was a neighboring house just 2 doors down that became for sale. And when we started comparing and contrasting, we thought, shoot, there's a big difference. Because the one that we had, just literally a couple doors down, the rent estimate, everything was the same. But that other house had new vinyl siding, new windows, new roof. This house had wood siding, old wood windows, and not as new of a roof. The other one had a new furnace and water heater. This one didn't have a new furnace and water heater. So I'm expecting that over the next 5 years, like the neighboring house won't need much of anything. And the house that we currently own over the next, maybe it's more like 10 or 15 years even, but there's a much shorter runway to needing some expensive repairs than on that other house. And that can be a really big difference. You know, even if just in the next 5-10 years, we're thinking 15 grand in repairs, like that's a chunk of money to save up for in the next 5-10 years.
Especially if it is only 5 years, right? So $15,000 over 5 years, that's $3,000 a year. There goes a lot of your good cash flow. So that can really start to add up over the long term.
Yeah. And at $3,000 a year, I think that's a really good number to work with, because at $3,000 a year, if you're setting aside $500 a month, $50 a month, you don't come anywhere close. Like you need more like $250 a month to hit that target to make sure that those expenses are covered. So you have to set aside much more for CapEx than a lot of calculators will initially show you, because calculators are built on assumptions where you need to plug in these kind of property level nuances. And this is where addressing the CapEx calculations, what are those impending expenses, becomes really, really important.
So you're going to flip the one then?
Yeah, that's kind of what we're thinking. Just knowing kind of where the market is at right now and knowing what these expenses are going to be, we're really tempted to like sell the one that we're working on and then go buy the neighbor's like go buy the one that's 2 doors down, because like we can hopefully get out of this one, get into that one at a similar price point, but then reduce a lot of our headaches long term.
Maybe see if they'll trade with you, just like straight swap, you know?
Yeah, exactly. Yeah. And the one thing about that is, because I don't want that to come off sounding like I'm just going to like dump a headache off on someone else, right? Because that's also not it at all. Like just because it doesn't meet my criteria for a long-term rental doesn't mean that someone else might not really like that house, you know, particularly because it will be worth less than this other house with nicer features and everything. So maybe someone's looking for a little bit cheaper entry point where they can get started and they can do some updates and do some fixes themselves, and they can build value and equity living in that house. Like I know that there's a lot of house hack pharmacists that are looking to do that, to get into a property, and maybe they want to paint it themselves. Maybe they want to, I don't know many pharmacists that are also roofers, but who knows? Maybe they want to do the roof themselves. But the point is that there are some owner occupants that will want to get in there, and that will be a great fit for them. And so just because it's not a great fit for me doesn't mean it's not a great fit for someone else.
Yeah, that's a great point to remind people too, is like stick with what works for you. Trying to go in 10 different directions and do everything, it's just too difficult. So stick with what works for you, stick with your criteria, and dump the stuff that doesn't meet it and move on.
So yeah, that property is looking more and more like it'll be a flip. We'll have to see how it comes out in just a couple more weeks. We're hoping to be done here soon. So yeah, that's property level expenses, which is our first consideration. And so as a realtor, I know you're very familiar with the second consideration, which is trajectory of neighborhoods and value shifts and all those kind of things. So help us out with the difference. Like my kind of question off of that is, we've seen all kinds of things about the overall housing market, but talk for a minute about overall housing market and specific neighborhood trajectory and how those can sometimes be similar and sometimes feel disconnected.
Yeah, this is such a difficult spot, right? Because there's two big pieces, like you said, and it's all even hazier than normal because the near term is difficult to figure out. But like you said, when you're looking at a housing market in general, you're looking at two big things. You're looking at, generally speaking, the housing market, and a lot of people have been calling for a dip, either shallow or drastic, for the better part of the last decade, and we're still seeing it climb. But generally speaking, people are expecting some sort of shift in that market. But case by case basis, you're also going to see individual neighborhoods, individual areas that are going to go against the general market trends, down or up, right? And so you have to take both those things into account. It's just like the stock market, right? If we zoom out, right, the S&P 500 or the Dow, they're going to do one thing, but an individual stock is going to do something totally different. And sometimes they go together. They both are rising together. Sometimes one falls, one rises, and vice versa. So you have to evaluate both and really start to look at both of those things before making a decision about what that market's going to do for you.
So it sounds like, the US housing market could do one thing, but housing in LA may go in a different direction than Boise, than Dallas, than Albany. And does it get more complex than that? Like, talk for a minute about some of the neighborhood or even block by block considerations that filters into that.
Yeah, 100%. I mean, there's a great example of one of the markets that I invest in here locally, that the city itself is on an upward trajectory. But if you're west of a particular road, the houses over there are 2/3 the value of the houses that are east of that particular road. And they're trending down. Nobody wants to live on that side of town. It's closer to a higher crime area. It doesn't have great access to some of the amenities that city is really benefiting from. And so again, it's crazy because you look at a city and the city is all increasing. And again, you probably get I get like the Zillow emails every week, which is like, the properties in your area are going up 12.5% next year. But I guarantee if I was to be able to boil down this particular neighborhood of that city, it would actually be going down quite a bit. And that's difficult to be able to figure out without boots on the ground, without somebody that knows the areas and is really living and breathing in that neighborhood. But again, it's a really essential part of what we're doing, because if you don't have that, you can miss things on that long-term plan.
Yeah. So not just looking at US trends, but city trends, neighborhood trends, block by block trends. And what about even one thing we've talked about on previous episodes too, is looking at value within a specific property. So for instance, we bought a 2-bedroom house and converted it to a 3-bedroom house recently. And in doing that, we were able to capture a lot of value that wasn't previously there, because as a 3-bedroom house, it appraised much, much higher than it did as a 2-bedroom house. So how does that filter into even kind of the home search and things that people are doing right now?
Yeah, especially if you're looking at things where, you're targeting a particular area where perhaps you want more of a family target, right? We're going to have more bedroom count than typical. So if you're buying a 2-bedroom, where those typically aren't selling as high because most of the houses in that market are 3 and 4-bedroom, but you're able to take a 2-bedroom and convert it very easily into a 3-bedroom, you might actually bump your house into a more desirable position than it would have otherwise been. So there are ways you can really work within a market to change a property to fit the statistics that you're looking for. It's more difficult, and it doesn't work with every house, but it's definitely something that if you can be smart and look at a property in that way before buying, you can really find a diamond in the rough, so to speak.
Yeah. So I know that there are people that are looking at some of the national headlines right now and are stressed. I know that you and I might be a little biased, but we're still buying, right? So
far.
But definitely looking at this different picture of like the US housing market do one thing, states, cities, neighborhoods, blocks, even just house itself, like there may be opportunity for value. And by trying to find something that's moving in the right direction or that may be inherently undervalued, I feel like is one way to hedge against some of these trends that we're seeing right now.
Yeah, I think there's always going to be an opportunity to buy, no matter what the market is doing broadly. I think you just have to really be good with your numbers, right? You don't want to be buying things that, and I've always been like this, right? Ever since we started investing, we're never going to buy something that everything has to go right for the numbers to work, right? It really, the way I build it is if everything goes wrong and the numbers still work, like then great. It's a fantastic buy, right? That's what we're looking for. But if everything has to go right just to make it a deal, then to me, it's not a deal. And in this market, in the way things are changing and with the ambiguity of the next 6 to 12 months, that's never been more true. So I think if you are concerned about, gosh, this market is scary, I don't know what's going to happen. Nobody knows what's going to happen. It doesn't mean you should quit and walk away. It just means you need to be really diligent and really sure of your numbers before making a decision.
Yeah. And not just sure of your predictions of national trends, but also at state, local, neighborhood trends, because just as some neighborhoods may be going up, your example of a neighborhood that can be going down, like even if we see a continued, say, 10% incline of the national market, for example, a neighborhood could still drop by 10%, or if the national drops by 5%, that neighborhood may drop by 15. So you want to try to understand that nuance so that you are staying in front of those trends as much as possible.
And be careful too if you're looking to flip, right? Like, and again, we just talked about we're selling houses here and there, but if you're looking to flip and you're saying like, this is going to be a flip target, it has to be this, and I want this to make sure that it goes up and it's got to go up by a certain percentage. Those are ones where I would maybe take a step back and just make sure that, again, that multiple exit strategy thing, that if the market goes south and it does drop 10% in this particular neighborhood, or nationally we go down 15%, let's say, if that house still works as a rental, then you've created a safety net for yourself, right? So that multiple exit strategy thing, the running your numbers before you ever get into it, that is so much more important than it's ever been before. And I really advocate for that. That's the way that I'm operating today.
Yeah. Conservative numbers and finding those opportunities of value so that you can have a hedge against that as well. Like one house that we just offered on recently was just this. A few years ago, someone had painted it just Pepto-Bismol pink. And I was pretty convinced that that was going to be a difficult one to sell, right? But I also know that we can go to the store, we can get some paint, we can repaint the house not Pepto-Bismol pink and make it a lot more desirable for a lot more people. So there may even be some pretty simple ways to shift value in a property and to find something that's undervalued because it's ugly or dirty or whatever else is going on. So yeah, those kind of things, particularly in these situations where there's some market uncertainty, just sticking to the fundamentals, trying to find things that are undervalued so that you're making a wise investment, not just getting caught in the hysteria of the, market's going up everywhere, like all these properties. If I don't buy now, I'm never going to get to buy, like not buying into that narrative, but just sticking to fundamentals and making conservative, cautious decisions.
And again, when you're doing market evaluation, like you said, the fundamentals are key. Are there market factors that are driving growth in an area? Or are there market factors that are driving demand and pricing? Like, did Amazon just build a new warehouse down the street? Or did the hospital just build a new wing and they're hiring 500 individuals to house that? Like, those are all people going to influence into that community and influx into that community. Now, all of a sudden, you've got more competition, more housing is needed. All those things, again, just like we do anytime you're evaluating a market, that stuff doesn't go away just because the rest of the market is crazy. That stuff can still stay around and can still help you make a decision.
Yeah. If you're not as plugged into some of those are things that realtors often are. So again, get a good realtor, stick with that realtor and have a lot of those conversations about cities and neighborhoods and where to be and where not to be when you're looking at buying a rental property and holding it for X amount of time.
For sure. So good. Well, so we talked about the first consideration, which is property expenses. The second, which is neighborhood trajectory. And I know you're passionate about the third one, David. So that's what to do and what do you plan to do with the money after you sell. So let's talk a little bit about that.
Yeah, I think this is a definitely overlooked consideration. Like when you sell a property and you take that money off the table, because presumably there's hopefully some equity in that property. Oftentimes with an investment property, you're putting 25% or more down on that property. So when you sell, there's equity that comes back to you. And I had a friend talk to me recently and say that, he was pretty convinced that as he looks at his crystal ball, he's expecting a 10% market drop over the next year. My crystal ball is not all that clear, but if we go with his assumption of like a 10% drop over the next year, which I'm hearing different people saying, I'm not trying to say that's necessarily wrong, not trying to say that's right, but if we see that 10% drop over the next year, he said, why don't you sell some of your rentals, park that money on the sideline, and then go buy a property again once property is, on sale by that 10% dip?
Yeah, I mean, the first thing that comes to mind is that selling a property is not cash neutral, right? It's not just free to do that. I don't sell a $150,000 house and put $150,000 in my pocket. There's, again, the biggest thing that comes to my mind is realtor fees, especially. Like if you're listing that property with an agent, we charge to do what we do. And so that's going to be the first expense that comes to my mind.
Yeah, and definitely. Like in my market, it's common for both the listing agent, the buyer's agent to make 3%. And then I tend to estimate another 3% in closing fees and taxes and all the other just transaction costs. So I estimate 9% is gone when I sell a house. So if we have a rental property worth $200,000 and we put a sign in the yard, it sells for $200,000, I plan on a net of $182,000 off of that.
Yeah. And it sounds about right. My numbers are a little different because I can list mine without some of the commissions, which is nice. One of the small advantages of being a real estate agent. But you're right. I mean, all those things are there. You've got transfer taxes, even that you mentioned. And, even if you've held it, depending on how long you've held it, there could be additional taxes too.
Yeah. Like let's say, for instance, the capital gains tax would be one, where if you bought that property for $150,000 4 or 5 years ago, now it's worth $200,000, then you're paying tax on that gain as well, which is just the same as any other investment, right?
Yeah. I mean, just like if you put $150,000 in stocks and it went up in value and you sold that, like you're going to pay taxes on that. It's the same thing. It's just real estate is not immune to that. And I think it's harder to see because you think about these properties selling and it just feels like money coming back to you, but it's the same outcome.
Right. Yeah, you definitely walk away. Like if I were to sit on the sideline with that now $182,000, like there's already a issue there. If it's not parking $200,000, it's parking less. And if we talk about cash flow, let's just say theoretically that property, that $200,000 property cash flowed $400 a month. So after all the expenses, mortgage, everything, there's $400 a month left over. Let's just say for round numbers, that's about $5,000 a year. So that's $5,000 in cash flow that I didn't make if I put that property on the sideline and it just sat.
Yeah, exactly. And so between the costs associated with selling, you've got taxes, the lost rental income. Like you said, you're losing that cash flow. I mean, it's not nearly fair to say that you could sell a $200,000 house, pocket that or park it somewhere, and then, use it again later at that same value. It's just not going to work that way.
Yeah. So, in this scenario, like, we could get into complex discussion of tax and all those kind of things, but let's just say that it was more like 180. We already said 182 after the realtor fees and transfer taxes. Let's say it's more like 170 after capital gains and other things that are going to play into that. So if I'm going to sell a $200,000 property, have $170,000 there, and then go try to find this, mythical 10% discount and try to buy a property at 180, like that no longer makes sense. Like even though the market is dropping by 10%, there's not really a gain if my purpose is to set that cash on the sideline and go buy something exactly like what I just had.
So you're saying I can't day trade real estate? That's really a bummer.
Yeah, not quite as easy as day trading.
Just harder to do. All right, that's fair.
Yeah. And there are more advanced strategies. Like we could talk about 1031 exchanges. Like I know someone out there is like got their tax hat on, right? And they're saying that like there's ways to avoid that. There's other there's fancy footwork that can be done. But yeah, it is definitely tricky to time any market, let alone the real estate market, because another issue would be like, what if we don't see a 10% drop? Yeah. Like what if it's a 5% drop or it's stable? But on the other hand, what if it's a 20% drop? Maybe it starts to make more sense to sell some and that kind of thing.
And that leads me to, I guess, my next question, like, when is it time to sell? So if selling and parking doesn't make a lot of sense, like when is it a good time to say, you know what, it's time to cut out of this property? Because obviously you and I do this all the time. Like we are taking properties and selling them, but it's for a purpose, right? That's the idea.
Yeah. And so there may be reason to sell, like a couple things that come to mind are one, there may be reason to sell a particular property because of something about that property that you've learned over the course of owning that property. And another thing is, maybe there's something better to do with that money than just park it on the sidelines and wait to buy something like it. Maybe there's a different purpose. So for the first example, we bought a house several years ago that we got really cheap. We were excited about it. It was on a busy street and it had a shared gravel driveway. And those two aspects, like gravel driveway in Michigan, when we get snow all the time and you're shoveling and all this stuff, like it's just not fun. And a shared driveway is less fun. And then trying to like back out of a shared driveway onto a busy street in the morning in heavy traffic, like just makes it less and less desirable. And so we had a hard time getting that property tenanted. And eventually we decided like it's time to sell. And we had a hard time selling that property in a market that's not as hot. you're listing houses and helping people buy houses all the time. I have a feeling that in today's market, like if you have a property that has something painful about it, like this is probably a good market to try to sell a problematic house, right? Because people are overlooking everything right now, right?
Yeah, if you have a house in Cleveland that you want to sell, I'll give you my number after this because like selling leads right now is great because like you said, the inventory is so low that people are overlooking problems, fully disclosed problems. I mean, I've seen properties where in the disclosure, they're saying massive leak in kitchen, roof needs, rebuild over this half the house. And someone's like, yep, totally fine. Waiving that. I get it. I can handle it later. Like it's just incredible to see some of the things that are being disclosed and aren't bothering people. Whereas if you went back a decade and it was a real buyer's market, I mean, those things would have been, it would have crushed the house. It never would have been able to sell until you fixed it. So it's really interesting to see where we're at today.
Yeah. And again, it's not trying to say like dump off all your problems on some unfortunate person, right? Because like there are people that want to get in there and they don't mind the shared driveway. If they work from home and they don't need to back out at 8 a.m. like everybody else does, like maybe that's just not a big deal for them. And they're able to get a property less expensive because of that. And that's a win. So just because it's not a fit for you doesn't mean it's not a fit for someone else. And so thinking those kind of things through, this may be a good time to sell a property because of features about that property or something that you've learned where you just don't want to own that property long term.
The other thing I think about too is using a sale of a property for debt management. So if you wanted to pay off another rental, if you wanted to pay off some student loan debt or some other high interest debt that you've got sitting around, selling now when the market is high and using that capital right away to pay down some other high interest debt or to get out from under something else, or to pay off debt on a property where the cash flow is much better, like that can be a really good advantage as well. So as long as you're using that money right away for something that is benefiting you, it can be a great time to sell as well.
Yeah, I think another thing that I'm hearing people doing is if you have a property that is appreciated greatly in value, where you can get your down payment back plus a lot of appreciation back, there may be a way to trade up in this market too. Knowing that you're buying an expensive asset, but because you're able to get out, maybe 2 or 3 times what you initially put down in the first property, maybe you're able to buy a 2 or 3 unit property instead of a single family, or maybe you're able to buy 2 or 3 houses by selling the one, or, there's ways to scale up in this market. And so particularly if those new properties that you buy can be found at a discount or in a better neighborhood, or there's other things you can do as well where you can harness positive market conditions for those houses, you might be able to really accelerate your investing by selling strategically and redeploying that equity into one or more different properties.
So bottom line, it sounds like if you're going to sell, have a reason to sell. And it's important that you have something to do with that money afterward. Parking in a savings account, probably not your best plan of attack.
Yeah. And who knows? There may be someone that really just wants that money in a savings account to sleep better at night, right? Like each their own. But yes, to your point, having a plan is crucial, right? Like having a plan so that you don't sell that and then think, why did I sell that? That was a great investment. Just because the market went up, why did I sell that thing? I should have kept that, right? So yeah, that can be a really tough decision. And it sounds like one you're right in the middle of right now with this house in Cleveland, right?
Yeah. So help me out, David. Like this is a real example. I've got this house. It's almost done. I've got a couple more hours of work and like one contractor job left, and then it's ready for listing. But should I sell it or should I rent it out? I'm really split on what to do, actually.
Yeah, well, and it sounds like, so refresh me a little bit with all the projects, but it sounds like you've done a lot to take care of a lot of the short and long-term expenses, right? Is there anything out there pending or looming that you're worried about?
The only big one that's looming is that I did some roof repairs, but not a roof replacement. So the roof would probably be something that in the next 8 to 10 years needs to be replaced. So that's kind of long-term and not bothering me too much. But other than that, all the big stuff has been, I guess, the furnace as well. The furnace is about 15 years old. So that's got another 5 to 8 years left probably for that needs to be replaced. But otherwise, all the big stuff's been taken care of.
Okay. Well, that's kind of a check mark in the maybe keep it category, right? So yeah, what about neighborhood trajectory? How do you feel about the neighborhood?
I love the neighborhood, and it's funny. I have this kind of block that I'm always looking for houses in because I'm obsessed with this neighborhood. Like if we were in a different stage in our life, we would live there ourselves. It's just it's so walkable and just awesome. The interesting thing though is that this is right on the edge of that neighborhood. The backyard actually overlooks like a street that is much busier. So it looks onto some businesses and it's a busier street beyond that. So it's right on the edge of this good neighborhood, which is every time I'm over there, I'm like, oh, I love this neighborhood. And I'm like, oh, but this backyard isn't the best. Like it. So it's kind of half and half on that one, I guess is what I'll say.
Okay. And if you were to sell it, I'm assuming that you would make some money, for all the work that you put into this, buying it smart, all those things, you'd walk away with some cash, right? So
yeah, conservatively after realtor fees, and again, I'd pay basically half the normal realtor fees. I wouldn't charge myself to list it,
right?
But I'd pay the buying agent a fair commission. I'd probably net about 20 grand or so if after it sells and everything else clears and all that stuff. So call it 20 even just to be on the safe side.
Yeah. And that's $20,000 flip profit, not just getting your down payment back and things like that, right? That's profit coming back to you.
Correct. Yeah. So if we sold it where we want to, it'd be $20,000 after everything's paid off and we paid off all the credit cards that we used to do all the rehab. Now we put $20,000 back in our pocket. So really, again, a good situation to be in for sure.
Yeah. So then aside from just getting that money and potentially parking it in a savings account or anything, like what would the intention be? Like what's kind of the opportunity cost if you don't redeploy that somewhere else? Or what are the things you're thinking about?
Yeah, I mean, we originally bought it to burr it, right? We wanted to use it as a high cash flowing rental. And again, we bought it really cheaply, put in a ton of repair costs. And so the thought was, well, we'll burr it. We'll pull our money back out with a refinance. The problem is now that rates have gone up so much, I mean, literally since we bought it in December, we're at 4.625, which even at the time I was like, wow, it's going up there. I wouldn't be able to burr it for anything less than 6.75, maybe even 7%, quite honestly, as a cash out refinance. So our mortgage, I was doing the math before we started talking. Our mortgage today is just south of $400 a month, right? Super cheap. It would almost be $800 a month if we were to cash out refinance it. So you're talking about getting all that capital back out, but taking away $400 a month in cash flow. But it cash flows about $450 or $500 a month, depending on how you do your numbers to begin with. So now we're basically eliminating all that cash flow.
Yeah. And I'm sure someone in New York City just like fell out of their chair hearing you like complain about an $800 mortgage payment, right? So like everything in every market is relative, right?
I get it.
But yeah, so the numbers may not make as much sense on a rental versus, but what else would you do with that money then?
Yeah, so we could turn it around and ideally invest it into other properties that are going to be able to cash flow better or just as well. And then I could split it out over multiple properties. So if we pull all that money back out, we not only get that 20 grand in profit, but we get all the capital back that we can use and redeploy. So again, we've been really trying to find a short-term rental recently. This would really help us expand our budget on that. So there's options there. We would certainly use the money. We would be turning around and doing something with it. It's just a matter of, where does it go next?
Okay. So that maybe puts a check in the column of sell, right? Because you have a very intentional plan with what to do. You're giving that a lot of thought and you're running the math. It sounds like on one hand, you're either going to scale up to a more expensive, hopefully more profitable short-term rental, or you're going to scale up to multiple houses or multiple units or something like that, where all of that makes sense with today's interest rates, because today's interest rates are what they are, right?
Yeah.
We're recording this in May and who knows by June, July, where rates could go and all those kind of things. So, but being intentional about like knowing just the reality of the environment, what makes a good investment today, you're giving that a lot of thought and coming up with some strong plans. So yeah, tough one.
Yeah, I think it's just, this is exactly why it's difficult to give one answer to any particular property. I think there's so many different factors to consider, but hopefully us going through these different considerations will give others in the exact same situation as me a little more clarity. Again, after having this discussion and talking with you about it, I think I'm leaning 70-30 sell right now. The burr option, the refinance option is just, it doesn't make any sense, right? It kills the cash flow. The keeping it and leaving all the money stuck in the deal isn't terrible, but if we do have a market correction, now I'm leaving a bunch of cash in the deal and I'm losing money on the like what I could have sold it for. So it feels like I'm leaning more and more towards sell, but we'll see. It has to, maybe I'll put it on the market for 2 weeks, see if I get a bunch of activity, and if not, then I'll go ahead and rent it out. Maybe that's the plan.
Yeah, no, it's always a tough call. And I know that a lot of people are in this situation where, either a rental property that you've had or a project you're working on, or those kind of situations are causing people to chew through some of these tough decisions. So I know another thing, if you're struggling with this, like, yeah, Nate, you and I talk about bouncing the stuff off each other all the time where I'm like, man, do I keep this one or do I sell? Right. What do I do? Like, we're trying to figure this out. And so that's where, networking with other investors, if you don't have someone like that you text or call, like jump into YFP Real Estate Investing Facebook group. That's a great place to pose one of these questions. Like, here's this house, here's the cash flow, here's the numbers. If I sold it today, I could walk away with this and do this. Like, what would you do if you were me? What makes the most sense? And you can get great feedback from a lot of different people, the community of other pharmacist investors that are wired like we are to be risk averse and all the things that pharmacists are, detail oriented. So it can be a great way to get some additional feedback as you're working through these tough decisions.
Yeah, definitely recommend you check out the YFP Real Estate Investing Facebook group. I'll probably be posting what I end up doing with this house on there too. So if you want an update, that's the place to find it. And again, hopefully this helps you guys out as you're contemplating what to do with your own rentals or your own properties, that is. So with that, I hope you guys have a great rest of the week, and we'll see you next time.
Before we wrap up today's show, let's hear an important mention from our sponsor, Lima One Capital. Are you a real estate investor looking for the right lender that can finance all your deals and help you scale? Lima One Capital is the best suite of loan products in the industry. Whether that's fix and flips, fix and holds, building new construction, or buying rental properties, they have incredible financing solutions for it all. A reliable, common sense lender is one of the most important parts of your investment team, and that's exactly what you get at Lima One. Let Lima One Capital show you how they've helped thousands of real estate investors scale and increase their wealth. Check them out at limaone.com/YFP or call 800-259-0595 to speak with a consultant in preparation for your next project. That's limaone.com/YFP.
Thanks for listening to the YFP Real Estate Investing Podcast. If you like what you heard on today's show, please leave us a review and subscribe to the show so you never miss an episode. If you have a question, know someone that would make a good guest, or want to connect with Nate or David, head on over to yfprealestate.com and join the growing YFP Real Estate Investing Facebook group. As we conclude this week's episode of the YFP Real Estate Investing Podcast, an important reminder that the content in this podcast is provided to you for your informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in the podcast and corresponding materials should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with a financial advisor with respect to any investment. Furthermore, the information contained in our archived newsletters, blog posts, and podcasts is not updated and may not be accurate at the time you listen to it on this podcast. Opinions and analyses expressed herein are solely those of your financial pharmacist, unless otherwise noted, and constitute judgments as of the dates published. Such information may contain forward-looking statements which are not intended to be guarantees of future events. Actual results could differ materially from those anticipated in the forward-looking statements. For more information, please visit yourfinancialpharmacist.com/disclaimer. Thank you for your support of the YFP Real Estate Investing Podcast. Have a great rest of your week.